Okay, today we're zeroing in on a single point of failure that, frankly, underpins the entire global economy, the Strait of Hormuz. Our models are showing an incredibly direct link between any disruption here and the price shocks that hit consumers all over the world. And look, this isn't some theoretical risk we're talking about, John. It's an active, ongoing vulnerability. So let's break down just how fragile this whole situation really is.
The data here is pretty stark. When you look at the narrowest point, the shipping lane is just 39 kilometers wide. Think about that. That's the entire leverage point for a huge chunk of the world's energy supply. Exactly. And from a strategic point of view, that narrowness, well, it's a defender's nightmare and an attacker's dream. It creates the perfect choke point.
So to really get a handle on the risk, you first have to understand the sheer volume of what we're talking about. Let's run the numbers on what's actually flowing through this gateway day in and day out.
Okay, let's just start with the headline number. The data shows that roughly 20% of the entire world's daily petroleum consumption passes right through the Strait of Hormuz. 1/5 of all global supply is getting squeezed through this one tiny gap.
And this isn't just about oil. The numbers for liquefied natural gas, LNG, are almost identical. We're talking about 20% of the world's LNG supply, most of it coming out of Qatar, also having to pass through this exact same choke point. And that, right there, is the critical second-order effect that so many people miss. This isn't just about the price of gas for your car. This is a direct threat to electricity grids and winter heating for major economies, especially in Asia. It's a dual fuel dependency, and it's all concentrated in one single point of failure.
So the hard number for 2024 is 20 million barrels of oil every single day. And as the models clearly show, there are just no viable alternative routes out there that can handle that kind of volume, not even close.
Which brings us to the nature of the threat itself. We really need to throw out the old idea of a conventional naval blockade. The modern conflict here is totally asymmetric. We've started calling it a war of intolerability. And here's the crucial point to grasp. An adversary doesn't actually need to sink ships to achieve their goal. The real objective is to weaponize risk itself. All you have to do is make transit so dangerous, so unpredictable, that it becomes commercially impossible for companies to operate there.
And we've seen a very clear four-step playbook of harassment emerge. It always starts with threats and intimidation, then it moves to things like GPS jamming and seizing ships. Then it escalates to drone and missile attacks, and finally, it culminates in the most disruptive tactic of all, the threat of covert mining.
What this creates is a classic cat-and-mouse dynamic. The attackers use cheap methods like drones to create widespread chaos. And in response, the defenders, the navies, the commercial operators, they're forced into this constant, very expensive cycle of adaptation. It's really a strategy of exhaustion.
So where does this economic pressure actually hit first? It's not at the oil fields. John, let's take a look at the financial markets. Exactly. The first and by far the fastest ripple effect is always in the insurance market.
Yeah, the data we pulled from the 2026 flare-up is absolutely crystal clear on this. After just a handful of incidents, war risk insurance premiums for tankers going through the straits surged by over 1,000%. In some cases, coverage was being repriced at 60 times what it cost before the crisis. And this right here is the critical takeaway. The economic damage starts long before a single barrel of oil is ever actually lost. The mere threat is enough to trigger a massive financial shockwave simply because risk gets repriced across the entire board.
And this is the end goal of that strategy we were talking about, commercial intolerability. It's that tipping point where the ship owners and their insurers finally look at the numbers and decide the risk just isn't worth the reward anymore. The route effectively closes, not because of a line of warships, but because of a spreadsheet. It's an economic blockade, and it's every bit as effective as a physical one.
So, let's connect all this back to the real world. How does this high-stakes geopolitical game actually affect the average person's wallet? Well, the transmission mechanism from the strait to the consumer is unbelievably fast. Let's just trace the timeline.
Okay, so day 1, an incident is reported. By day 2, just 24 hours later, insurance premiums have already gone through the roof. On day 3, that risk gets priced into Brent crude oil futures. And then, within just 7 to 10 days, bam! That price increase shows up right at your local gas pump. It's a direct and incredibly rapid pass-through. And it's never just about what you pay at the pump. The EIA data confirms this over and over again. These energy price spikes feed directly into broader inflation.
We see it in transportation costs and manufacturing costs, even in the price of groceries. A shock in the Strait of Hormuz quickly becomes an inflation shock for Main Street.
Which brings us to the really scary part, the long-term consequences. It's really easy for people to just dismiss this as a temporary price spike, but the damage is often systemic.
A question we always get is, well, why not just use other routes? This chart really illustrates what we call the substitution myth. You can see the existing bypass pipelines in the region. They only provide a very small buffer. They can't come anywhere close to replacing the 20 million barrels a day that flow through the strait. There is just no quick fix here.
Exactly. And when the market realizes there's no easy substitute, it starts to price in that risk, permanently. This is what we call the geopolitical premium. After you have repeated crises, the baseline price of energy doesn't just fall back to where it was. The market now expects instability, and that expectation carries a permanent cost. We all end up paying more simply because the future is seen as riskier.
And the long-term data shows a really clear pattern of consequences. We see sustained increases in shipping and insurance costs, a constant drain on strategic reserves, incredible supply chain pressure on our allies, and of course the ongoing cost of naval deployments. It all becomes this permanent drag on the economy.
So at the end of the day, the numbers tell a story of immense, almost unbelievable risk, all concentrated in this one single location. Which really leaves us with the final question. This isn't just about the price of oil. It's about the hidden costs and the profound fragility of a global system that we've built on these incredibly vulnerable choke points. In an economy this interconnected, what is the true price we're all paying for that dependency?